All righty, folks, we got great feedback from y'all when we took a topic and we tried to steelman both sides. So Anna Kelly and I are going to take another honest attempt at that. Today, we're going to talk about what happens if the 10-year note is 6% in video number 1, this one right here, and in video number 2, which will come out in 24 hours, what if the 10-year is sub 4%? So Anna, thank you so much for entertaining my audience and giving it an honest effort. For the first episode, we're going to assume the 10-year, and let's assume the 10-year gets to 6% sometime in the next 60 days, right? We'll put a little bit of a time on that. So
which means the 30-year fixed mortgage would be somewhere between 8 and 9, because
probably 8.5 and 9.
Well, yeah, well, the lowest spread when there's not a whole lot of volatility is about 2%. Right now we've seen 2.5, but it's ticked up as high as 3 because of uncertainty for those, bond holders, that when you get your mortgage, they sell that as a mortgage-backed security on that secondary market. And so when you hear 6 as an audience, it means you're paying 8 to 9, probably 8.5. That 2.5% spread is pretty well where things have been. So it's a lot higher rate than what you're seeing even today.
Yeah. The other thing we got to realize is that's owner occupant rates. Investor loans are probably more like 9.5 or 9 3/4. So a 10-year at 6% is shocking. It's jarring because of what happens. And there's so many things in the system that I think breaks at 6% 10-year. But where does your mind go after mortgages?
The first thing is banking crisis. Again, not a lot of discussions, but you saw a couple banks start to fall, 3 of them to be exact, because of bonds being worthless and them having to write off bonds in order to get liquidity, not just write them off, but sell them at a loss, right? So when banks are sitting on treasuries that are at lower yields and suddenly the demand for those treasuries goes down, forcing rates to go up, the investors are demanding higher yields and higher rates. So what they already hold is now worthless. And so you could see more banks, just because of the bond rate changing, being finally forced to write these things off, to mark them to market or to sell them. And that makes their assets less than their liabilities, which makes banks insolvent. So that's one piece of it. The other thing it does is it makes their commercial real estate worth less, because again, commercial real estate and other investments basically are valued based on the income they produce, just like businesses, right? Divided by a going rate of return that investors demand for parking their cash in that asset. We call that a cap rate. And so, if a 10-year treasury goes to 6, an average spread on a cap rate's about 300 basis points, 230 to 320. So you're looking at, again, a cap rate that's going in that 8.5 to 9% range, or even more. And that makes asset values on paper plummet even further, which means more commercial real estate defaults. And regional banks hold a lot of that commercial real estate, the vast majority of it. And so they're hit with this double whammy that I have been talking about could happen if rates continue to stay even where they are. But if they go higher, commercial real estate defaults, more foreclosures, and that has the trickle-on effect, which is kind of what happened at the end of the 70s, early 80s, that caused the savings and loan crisis. The collateral that the banks hold is suddenly worthless, or worth a lot less, and it makes the banks insolvent, as well as the investors who hold those assets. So that kind of thing, Michael, it's not just, oh crud, I can't buy a house, the housing market is constrained. It's real financial crisis, financial meltdown, because of asset values going down and banks starting to become insolvent. And
I absolutely agree with you. We have a 10-year treasury at 6%. The banking crisis will require government intervention, right? Because if you go back and you think about Silicon Valley Bank, First Republic, and Signature Bank, which were the 3 that failed, that was because of the treasury.
Yes.
However, what people don't realize is there is a massive market for mortgage-backed securities.
Yes.
CMBS. And a lot of commercial banks own that. So if we see the 10-year, which today's trading, I think at 4.5 or thereabouts, go to 6, those assets go down substantially, right? Right now, they're living in extend and pretend and hopium, hoping
Yes,
rates go down. See video number
absolutely.
2. But they go to 6, it's going to be mark to market. It's going to be liquidation. It's going to be a bloodbath. And you're
Yeah,
right. I think the comparison to the savings and loan crisis is accurate. One thing about the Silicon or the savings and loan crisis is it was about a decade in the making. I think
absolutely.
you would see that collapse into a couple of years. And man, can you imagine the gobbling up of the big banks and the little banks? And it would
Yeah.
be ugly.
And for people who think, okay, this is doom and gloom, Tom Honig was interviewed not too long ago on either Thoughtful Money or Wealthy on, last year, probably early to mid last year. And he said, we're at a category 4 out of 5 chance of a banking crisis if rates stay too restrictive too long. And so, again, we're playing out a much higher treasury, but we
Yep.
already have a lot of risk of that happening. The banks have been somewhat calmed by the bank rescue, the bank term funding program that was able to keep us from having a banking crisis. But if rates went that high, I have no doubt it would be rapid and quick. And then the question is just how quickly and how much money does the government have to spend to try to prevent it, to bail out the banks, to bail out the investors. And because of the national debt that you and I keep talking about, we really don't have a lot of room to just spend and create quantitative easing and money printing. And if we did, Michael, we were able to do that post 2008. But the issue with money printing when you already have debt this high is it just makes inflation significantly worse, devalues your dollar. And so it having this kind of crisis at a time when you already have high US debt, it's going to be much, much harder, both on the fiscal side, what Congress can do, and on the monetary side, what the Fed can do to bail out some type of major systemic crisis. And in fact, Scott Bessent said in an interview that I was listening to, not long after the election, I believe it was last year, he said the U.S. is in such bad shape debt-wise that we can't handle any kind of financial crisis right now. And so, that's directly from the horse's mouth. So again, we're playing this out, but
Yeah.
it's not too far of it's not a beyond the realm of possibility that these things happen with what
it's a
you've seen.
non-zero chance. Yeah, non-zero.
Absolutely, especially with the tariff threats and things we talked about in our video last week. I mean, you look at the spread on mortgages right now; they've gone up again.
Up. Yes, they're going up again.
So it's too much risk, too much volatility, and we just don't know. I saw an article this morning, Michael. I didn't get a chance to read the whole thing, but I've pinned it to go back to. But it said something like a huge percentage of treasuries were dumped yesterday by foreign countries. A much larger percentage than, and last week people were saying, aren't you worried, to Bessent and to Letnick, that countries are dumping treasuries and they're going to force the yields to go higher to retaliate from our tariffs? He said, no, that's not happening. Well, I saw an article this morning saying it happened yesterday. Again, don't quote me on it. Have you seen that?
Well, I've definitely seen more and more articles. And actually, the title of my daily financial news this morning was Sell America. I think there's a lot more countries selling U.S. assets, whether it be treasuries and whatnot. And I think all you have to do is look at gold and, frankly, now Bitcoin for the last
3,400 today.
Yep, 35. Right? It hit 3,500.
Wow.
Right.
Wow.
It's not currently there, but it did hit.
That's more than 30% just this year. It's thankfully I bought a bunch at like 1,600, 1,700. I thought that was high. I mean, 34. But yeah, to that point, when we say what's the chances the Treasury could go to 6? I mean, we're seeing big moves. And if countries want to stick it to us and they dump treasuries, what happens is when you have less demand because they're being dumped, the yields demanded for those treasuries go up. And so we are seeing that trajectory moving that way. And the question is, how high could it go? So something definitely to think about and to say, what if it did happen? How would I hedge? And then after I hedge, how do I take advantage of the opportunity of a lifetime? Right?
Yeah, no, exactly right. Because it's really funny. I went right to mortgages, banking crisis, commercial sector, then to the government. The other thing that should be said about, the national debt is, Scott Bessent has been very clear, right? His goal was to get the Treasury down, right? See video number 2,
Yes.
sub 4%, because he's got all this short-term paper he's got to, refi out. If his hope was to term it out at lower rates, i.e., save us money, if he's got to term it out with a 6 handle, say goodbye, right?
Yes.
This thing goes parabolic, and we're not talking 38 trillion in national debt. We're talking 40, 41, 42 trillion.
Right.
And you want to see the world lose faith in the United States? That is not good. I don't want to be on that path.
Right,
I guess
because people don't think about the fact that we're issuing debt, so we have to pay the interest on that debt.
exactly.
So if those who buy debt, which there's a lot of it, maybe 30-ish% is bought by foreign countries right now, but
Mhm.
you also have these huge hedge funds, like
Yep.
funds, i.e., that you are invested in your 401k, right?
Mhm.
So you're going to see the stock market, those that are in bonds start to kind of tank. And you're going to have the US government have to pay those interest rates longer term at a time when we already can't get our debt down and can't even, have 3% deficit spending. I mean, we're at like 7. So the interest on that debt is already higher than defense spending. And I think Medicare and Medicaid. And so it's
Mhm.
like you
Oh
add
yeah, it's
higher
right behind
interest rates.
defense. Yep.
It's absolutely crazy. So it would be very, very, very bad for the United States and probably the worst financial crisis in my lifetime, I would say.
Oh yeah, 6%. I agree with that statement wholeheartedly. If we get to 6% and it sticks, it's cataclysmic to the financial system, and if it's cataclysmic to the financial system, like we learned in the GFC, it's cataclysmic to the economy.
Right.
Everybody gets hurt. Because
Right.
again, what happens? On the flip side, if you want to find a silver lining, you're actually going to get a decent rate on your savings. I mean,
Yes,
that's a good thing, right? So you get a decent rate
absolutely.
on your savings.
Yeah. Yeah. And I think, that's where, again, the unfortunate thing is these big wealth gaps just get bigger, right? Because the people that do have money, they're just going to pull it and they're going to park it and they're going to be paid higher. They're going to lock it into CDs and they're just going to sit and be paid to
Yeah.
sit and be patient. But the people that don't have a lot of savings, they can't take advantage of the opportunity, and they can
Yeah.
barely, they're barely living above check to check right now. And so if they start to see layoffs, which you'll start to see,
Oh, for sure.
companies, then the next thing is companies that are also extending and pretending like commercial real estate. They're getting their banks to give them a 1-year extension. Like, don't call our loans and our lines of credit. If you think they're already starting to lay off now, and they are with the stock market doing what it does, the bond market is significantly larger. And most companies have debt. And that's why it's important when you're looking at stocks to look at their debt and their cash, not just their PE ratio and what their earnings are, but you've got significant amounts of corporate debt that have extended and have refinanced, but they've done it with short-term rates because corporations, just like commercial real estate, can't get long-term loans like the 30-year fixed mortgage you have on your house. And so you're going to start to see some corporations start to fail, more bankruptcies, more layoffs. And so then you get into this vicious cycle where you've got deeply recessionary growth, negative growth, and at the same time, high interest rates. And that is so difficult for any nation to get out of, especially when they have the debt to where it is. And so it's this cycle that will just continue to spiral down if we got to a point where rates were really that high.
Yeah, if we think about 6%, 10-year note, 9% mortgage rates, probably, 18% construction loans. It just all ripples through the system. We would be
done.
done. You just
For
could
a
nothing
long
could pencil.
time.
Yeah. So when I think about all of that, I'm always to the point of where's the opportunity. I
Yeah.
think you would have at a minimum a 9-month spiral of just losses, right? As banks go bust, as banks reprice, as banks this, banks that. But at some point, a 6% 10-year would create, I'm going to argue, lifetime opportunities, better than the GFC.
For sure.
There would be assets on sale. Everybody would be scared. You know, there would literally be gold bars and diamonds laying on the ground for those that have the fortitude to pick them up. It wouldn't be immediate because you got to get through the rough patch, but
Yeah.
there'd be some upside, I think.
For sure. And that's where, the reality is most people don't take advantage of those opportunities at the bottom because there's just way too much fear. And so
Right.
everybody goes into preservation mode. And because you just don't know, a lot of people that have enough wealth and have cash sitting aside are relying on cash flowing businesses and cash flowing real estate. And when you have a very bad recession, let's just talk 2008, because that was the last big one we had. In certain areas, you're going to have tenants that can't pay. You're going to have customers who won't buy. And so you've got to be able to have the financial, not only the intestinal fortitude, right, but the financial fortitude to say, even while my income is going way down and it could go even lower, even while I'm still making these mortgage payments on the things that I do have, or these business loan payments, I see enough opportunity that I'm going to take some money and invest in things for the future in the long term, while you're dealing with the realities of the pain in the short term. And quite frankly, a lot of businesses and investors, whether you're in residential or commercial real estate or anything, in real financial crisis, they're first in like fighting fire mode. How do I protect? How do I not lose what I have when the income's not coming in to make my debt payments? So you've got to really be ready now to say, how do I preserve what I have? If we have bad recessionary type conditions, can I float the debt that I have? Can I restructure the debt? The good news is usually short-term loans, the Fed will drastically cut rates, because if the economy's that bad, they'll cut them back to zero. At least you got to rush in and refi all your short-term debt at those super low commercial type of loans. And then once you've done that and you've gotten your expenses down because your debt payment's down, then you can kind of handle less income coming in and go, okay, I've protected what I have. Now, what do I have left? And then you've got to be willing to invest it and hold for a long time, because an average recession lasts about 18 months, a really bad one longer, but an average recovery on a run-of-the-mill light recession is 2 to 3 years. And so if it's really bad, I mean, look at the GFC, Michael. It really took a decade to kind of get back. I mean, it was expanding, but recover. It was more of a recovery than a true expansion.
True.
Took about a decade to just get back to, real growth and real expansion. So if this was a bad financial crisis, you've got to be able to say, I'm going to take advantage of once in a lifetime opportunity, but most of that growth is probably not going to happen until a decade out. That's when you're going to realize the gains of being brave and running in and snatching up businesses and real estate on pennies on the dollar. So I'm ready to do that. I'm excited about it, but you have to realize when it happens, you're going to be scared, and you do need to protect before you put too much at risk. And you've got to have a long-term perspective, because these things do not just happen quickly. They're not get rich quick opportunities. They're, create generational wealth opportunities.
Yeah. At the end of the day, folks, 6% 10-year note would be horrific, I'll say, in the short term on many, many fronts. But like all crisis, like like to talk about, opportunity will be there. Folks, in our next video, we'll talk about what happens if the 10-year goes below 4%. My guess is the story is very different. Anna, you're amazing. We'll talk soon.
Sounds good.